The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour. Let's check out where we're at right now. We got S&P is up a whole whopping 2 points. So a lot of choppiness going on. We got the Russell is up about 3 right now. We got the Nasdaq up 9 with Dow down 2-3 points right now, depending upon the second that you look at it. Looking on over at oil, it is currently down 55 cents. We got natural gas is down over 3% on the day. Also looking at corn, it is currently down 3.5 if we're looking over at the November contract there. And checking out soybeans on December contract is up 14.5. And let's go ahead and look at the euro dollar. Euro dollar currently up 56 pips. Aussie dollar up 91 and pound dollar up 97. A lot of strength and everything but the dollar today. Dollar is just getting slammed across the board. Looking over at the dollar CAD, it is down 38 pips. Dollar franc down 50. Dollar yen down $1.11. So big mover is the dollar yen right now, down the most percent on the FX pairs there. Looking at the euro yen, it's down $1.04, which is only 0.79% compared to $1.11 on US yen being down $1.11. And then pound yen is currently down 75 pips. That's about 0.5% move right there. So if you're wanting volatility, there it is, right there in the FX. Gold, we got it up, 41 points, up 3%, and silver even higher, up 5.27%. Copper up over 1% on the day. So we're getting some moves. Not a lot of news this morning going on. We'll go ahead and we'll check that out in a second here. We had the existing home sales. It was, they were off. So obviously the numbers were off right there. And so with that, let's go ahead and take a look at a few of our FX pairs. And we can see sort of where they're sitting at and what we could do to, potentially take advantage of them. We'll do a quick run through over here. Like I said, we got the euro dollar. It moved on up one deviation right there. Again, we got a solid deviation move on the euro dollar, which was a nice, clean move. Pulled on back to about 0.7 and has just been hovering there ever since. We can go on and look at, and by the way, if we go ahead and we check out that news report impact. So one of the ones that I don't really label, even though it's a high impact report, didn't expect a high impact move on it. It came out at 10 a.m. We can see right here we really didn't get much. So at 31.95 up to about, I guess you could say within 2 hours, 32.18. So about 25 pips. That's why I don't go for it on that one. So it didn't really have much of an expectation on a move. In euro dollar, it's usually the big mover on the the existing home sales. And of course, homes being the big leading, supposedly, economic factor, and existing home sales declining. So, of course, that's with, got all these foreclosures starting to drop out of the market and things like that as well. So that's going to lower a lot of numbers down. We can check out, we'll go and we'll look at the pound dollar. So right here on pound dollar. Oh, I got it. It's taking for a minute. It's taking its sweet little time to load on up. And I might even open a fresh chart. That's just taking too long. All right, so let's open a new chart right here, and I think I got some other information in there trying to get up and running, and there we go. Got that. One more second for you, and I'll get that chart up on the screen. All right, there we go. So that'll open on up for us, and then we can see the deviation levels for the day. By the way, if you're wondering where I'm pulling these deviations from, they're coming right off of our scanner. So on the scanner tab right here, you can log right in and just click the deviation tab. And we have the Nadex, and a lot of people go, well, I trade Nadex. I trade FX futures. I don't trade spot futures. We'll just scroll down a little further, and you'll see the Forex futures. So we had the Forex futures in there as well, calculating that implied volatility. So that way you have everything that you need. And we can go in there, we can pull those up, we can look at, a lot of different things that we can pull, but the biggest thing is you just want to know how far the market's going to move. And I know I talk about these deviations every day. I get used to them. Sometimes if you're new, you're like, what's a deviation move? And how does that work? And basically a deviation move is, it's the bell curve. You may have heard of that before. And it's where, the highest probability range of movement is expected. It doesn't tell you what direction something's going to move. It tells you how far something should move. So should deviate, okay? Sort of makes sense, deviation. Should deviate from where it has been. And there's different ways to do deviation, all right? So one of those ways is to go in and pull standard deviation. Well, standard deviation, it's okay. But what is standard deviation? Standard deviation is simply a measurement of historical volatility. And when we're looking at historical volatility, that's how far the market has. Volatility means movement. Historical means has moved. Well, there's a problem with that. I'm not trading what has happened. I'm trading what is happening. So I want to know what the expectation is on future movement, not what the expectation is based upon past movement. I mean, you see in every disclaimer out there, past performance is not indicative of future results. So why would it be any different with standard deviation, okay? So I don't like using standard deviation because, again, it's past volatility. And, you can have a one-off news event, something like that makes a lot of volatility that really doesn't apply to, right now. You can also go in and you can look at things like pivot levels. And, I've used pivot levels. They seem to work great when they work. But when they don't, they don't. And I always got to ask myself, okay, anytime I'm using something, I got to ask why. And I'm not talking about why did it move. Okay, you'll figure that out after the fact. But I got to ask myself, why would this work? Why should it work? Okay? And so as I'm asking myself that question, I can't come up with a reason why the pivots would work, except for the classic, well, everybody else is using them, so therefore it should work because of that reason. Like, that's literally all I get. Okay, that's sort of all I can come up with on why, should this work. And so if that's not enough for me, to simply, well, it's everybody else's, and that's actually why a lot of indicators, seem to work for a while, is because a lot of people will use them. But if I can't figure out why it would work, and some of them, they just magically work, fib levels and things like that. It's pretty amazing if used correctly. Ways like, how Tommy O'Brien teaches, Steve Rhodes teaches, obviously Basil, and, just all the guys on here using the fib levels. They have, they have an uncanny ability, and part of that's, of course, due to a lot of people using fib levels. But if we go beyond that, and we go, okay, so what am I going to use to find intraday movement? And how far it should move, and if I'm going to use it, do I have a reason why I think that would be acceptable? Like, why I would depend on it, why I would make trading financial decisions upon it. And so one thing I learned a while back was how to do implied volatility-based extraction, which means implied means expected, and volatility means movement. And I learned that that's actually priced into the price of an option. So you can have a good idea on how far something's going to move on any given day, even over a period of time, based on the implied volatility built into the option price. And you can use the option price even itself as a bit of a way to judge and figure that out. So I'm like, okay, well, if that has the expected move built into the premium, so how much an option cost factors in how much it should move, which, if think about it, if you buy something like insurance, which options are, in a sense, a form of insurance. If you buy something like insurance, then the expected price would be built into that. So if it could move up or down, say 10 points, then they may charge, that's the expected move by everybody in the market. Then they may charge you $10 a premium on the upside and $10 a premium on the downside, basically trying to remove any edge by pricing all the statistics into the actual pricing. And so they put all those pieces in there. They price it out. Well, if that's in there, that's everybody putting their money where their mouth is. It's not some guy's opinion. It's it's not just one person's thought. It's not what happened yesterday. It literally is what is happening right now that's making people think the market's going to move. And I'm like, okay, so what now? We apply we got that number. So how can we use that for trading? So they think the market's going to move up or down, say 7 points on the S&P. Or, you go over to oil, up or down, 85 cents. Just different things like that. How can I use that in my trading? because, I'd like to use proper expectations of what other people think the market's going to do. That sounds like a good plan to me. And so I go in and I do research, and one of my mentors helps me out, devise and coming up with a intraday deviation formula. And so I apply the implied volatility number that I extract from like 16 different options, go in, I weight them, average them out based on volume, also other, complicated fun stuff. And of course I have a server do this now. I used to do it manually. It was really fun. And then go in, okay, what is 1 deviation? What's 2 deviations? What's 3 deviations? And so across the board on that, I'm able to put together an entire plan based on how far the market says the market will move on any given day. And that's where these implied volatility deviation levels, come from, is they come from the expectation of the markets themselves. So the pricing actually within the market. And that's why they're, really accurate a lot. And I don't know if you've looked at them, but if you've watched the show for any period of time, you've definitely seen, their accuracy. They just are, but it's not because it's a magic formula. It's just, we're just taking the price out of the underlying market options. So, if we go in and we look at different markets and go, okay, well, if that's true, then this is where markets should hesitate and pause and, do different things on different days, then I can probably use that in my own trading. So for example, if I'm looking at, oil, we can look over here at oil and we can see, looking for a movement. We have a movement up to about 0.5. It comes right down to a 0.7. Notice how it hits over and over and over again on the 0.5 deviation level before moving on down. So, different things like that I can use to know where do I expect potential pivots and most likely at least see a pause in price action. And if I can do that, then I can add that in. So now that I have it, well, that's wonderful. What do I do with it? How is it going to help me in my trading? Well, it's going to help me because it's going to give me a proper expectation. You ever been on a chart and you're so zoomed in, okay? Because, we're always zooming in and zooming out of our charts and everything else. You're so zoomed in on a chart that you really can't even, every bar, like if you zoom in at this point, the bars look huge. If you zoom in at this point, the bars look small. And you're on here and you're looking at this chart, let's say like right here, okay? And these bars look really massive, but you don't know if that's really a big move or a small move. So one of the things they do for me is by giving a deviation-based number, I'm actually able to see, get a relative idea actually of how far the market's moved. So that way, no matter what my zoom is, and I don't know if you, as a trader, you've had to experience this. You zoom in on charts and you're like, and then you zoom out and the chart looks really like it's moving like crazy, and then you look over and it's like, wow, that's only moving like the 5th pip on FX. Different things like that. And but I go over here and I look at this and I'm like, okay, well now I actually have an idea of how far the market's moving. And so I see a move up here like on soybeans, up to 1 deviation. And it goes up, and it's pushing like right at that 1.5 deviation level. Just some great, massive moves over there. And but it looked like it's trying to stretch a little further, see if it can get its way up to 1.5. I don't know if it's going to, but we had a great move on soybeans. But the deviation, it moved that deviation. It moved that expected move. I'll talk about the percentages when we get back.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, we'll come back here to the Diagnostic Trading Hour. And we just got some crazy stuff going on in the market right now. Oil just been getting slammed. And a little news story leak about Obama talking about releasing the reserves, the SPR report coming on out, and saying, hey, he's just here to help Main Street, and whatever your political affiliation is. Anyways, it's politics. I was actually talking with somebody over in the den, and talking about how it really comes down to all the new requirements coming in with all that stuff that's actually making the price go up. So the requirements that him and his EPA are putting into place. That's what's making it rise. But, people don't understand that, so let's go ahead and release some oil reserves and look like we're on their side, even though we're causing their price to go up. And, all this other stuff that's going on. But anyways, just politics. So, but we can go in and we'll check this out. I'm trying to see if there's any trades, but I don't really see any great last-minute trades popping on up for us. And I'm trying to see this if anything comes up at the last second. But we're really just riding right there on that line. The best we're going to get is maybe a 1337 sell on gold. And but nah, that's a little close. May want to stay on the sidelines on that one. So we'll see. But let's see here. Pull it on up. And we'll look at it, see if there's anything we think we can do. I'd like to do that trade. We'll get right back to the statistics on the deviations in just 1 second. So, pulling it up right now, and we'll see if anything pops up for us. And what do we got? Oh. Yeah, see, it's moving on up. So 1337, 24, 15. Yes, I don't know if we want to sell into this up move, this rise in the market right here. Trying to see if we get maybe a little turn down like in the last second we might be able to take advantage of, but we're still above that 80 MA. And we got, 4 minutes to go. So yeah, it could be very easily could move up that last point. And you'd almost be better off just buying the out-of-money one and seeing how it goes. So, I mean, just a point left to move on gold. It is, it's moving up pretty strong. So I'd be very cautious. I don't like the out-of-the-money because so often they just finish out of the money and sort of, finishing where they start. So I just have to, I want to make sure everything lines up. I want to take the right trade, the best trade that lines up for me. And, we can put those over here with our filters. We just go in and do 65, 95. And then we shrink it on down. It'll show us what's available. So on gold, really, that's all we got is that 1337. So we can keep our eye on it. I'll even click it, and it'll actually open up for me right in the screen there. And I'll have that so that way I can use it if I decide that that's the trade I want to take. So, but anyway, so we got that piece up, and we'll watch it just to see. We're looking at the August contract over there. And let me see here. Pull this chart out of the way on soybeans. Put this one back up. Yeah, see it's starting to move on back up there. But what I'm looking at right now is a potential gold 1337. But it's one of these trades. I'm probably going to put on it. If I do it, I'm going to do it like in the last few seconds. Just because we're talking like 7 ticks. Okay, 7 ticks of potential profit. And just really not worth it to me. So I think we're going to avoid, some of you may have hopped in that one. I think we're going to avoid it. Probably it's going to be a good trade, but I don't like the trend. I really like the trend working with me. I like the trend to be my friend, okay? And so just to show you what I'm talking about, see how our ADMA is going up right here? And our bars are closing up. We got sort of a little doji bar there or whatever, but all this thing has to do is close up a little bit higher. That trade's a loss. You'd be sweating like crazy right now if you're trading that 1337 gold long. So I prefer not to trade against the trend. Trend is your friend till it's not, etc. But, I only need the trend to be my friend for about 3 minutes. And I'm happy. So I'd prefer just not to fight it. But we'll see. That one may finish okay. So it's one of those things I got to look at. Is it worth it? And remember on those premium question trades in the last 2 minutes, okay? Those last 2 minutes, you can't do anything about it. So if it goes against you, you're out of luck. And I'll also keep like time and sells open. I always keep an eye on that, especially because really I miss what it's based on. It's like the last 25, and they take the average of the 15. And so I'll go in there and make sure that I'm looking at them and that they're lining up, so that way I can keep an eye. Because sometimes time and sell is the only way you're going to know if you're going to win or lose on that trade. But it looks like it's looking good. So if you got it, props to you. I'm not sure if it was the wisest trade, but it looks like that trade is going to work out. All right, when we come back, we'll talk about statistics on the deviation levels.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position, for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com. With over 3 decades of commodity trading experience, Andy Hecht has developed a system that combines both technicals and fundamentals. He calls this approach Technomental, and now you can put it to work for yourself with his brand new service, the Technomental Commodity Report. In this weekly newsletter, which comes out each Thursday morning, Andy gives you his analysis of the market price direction bias using fundamentals, and then specific trade recommendations including entry and exit points using technicals. The recommendations in the newsletter are always based on stocks and ETFs, so a futures account is not required, and Andy will often use options in the recommendations as well. Andy will tell you where to get in, where to get out, and he'll outline the risk-reward profile for all recommendations. To get your month-long free trial to the Technomental Commodity Report by Andy Hecht while locking in the low introductory rate, visit the front page of TFNN.com today. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome on back here to the Diagnostic Trading Hour. So one of the things we go over was these deviation levels. We have a section here that goes actually into the details on the levels. They can be used for all different things, okay? And basically, it's based on a one-day expected move from really settlement. Not so much close, but settlement. We'll talk about that. And we use these levels as a maximum expected move to set targets for profit potentials. So that's one way they can be used. Another way is for profit targets for exiting. Also, I use them for, of course, trailing stops is the number one way I use them. And they can help you out with just a lot of different ways in your trading. You know, premium collection, reversal plays, confluence, if you are using support, resistance, volume breaking down, Fibonacci levels, things like that. Then you can use them for confluence on your current analysis. And again, they're not standard deviation. They're not past movement. And they're based on future expected movement. So whereas pivot levels and things like that are based on basically just past prices, you know, past open, past low, past close. So the only past number we're using is settlement to be the because you have to have a number you're deviating from, okay? So the deviation price, and since the settlement is a price used for, you know, mark to market, it's used for deciding if options are in the money or not for exercise. It's a huge number. So therefore, that's the numbers that's used for deviation. And so should I, you know, plotting the levels on the charts? It makes it very easy. I think it's crucial. You need to put the levels on a chart. Other areas you might want to put are like overnight highs and lows, yesterday's highs and lows, Obviously, we have yesterday's close. So, and any, big magnet bars, things like that, like I talked about on previous shows. So let's look at the statistics. So what is half a deviation? There's basically a 34% chance it will not break this level. There's a 66% chance the price action will break out of half a deviation level. So, that's an area I might want to look for, breakout, like actually expecting it to go beyond that. Now, either half up or half down. So, now, again, this is touching, not expiring. So how far will the market move? Now, the next level would be 0.7. This is an area that I'm more about tightening stops than I am about anything else. So really, it's a big trailing stop for me. The one deviation is 68%. It will not break out of this level. So it's 32% chance that it will break the level. So this is really where we expect the market to slow down when it's moved a full deviation. And this is definitely where I'm going to be tightening my stops. And if I see that trailing stop trigger hit, a lot of times that's whenever you see the market, reverse, go choppy after that point. And then 1.5 deviations. So that's basically this is like looking for just another level for a profit target, also for trailing your stops. 2 deviations, 95%. It will not break out or touch this level. 5% it will break out or touch the level. So there's a very small probability it will ever hit a 2 deviation level. It does happen. And then 3 deviations is huge. We barely ever see this. 99.7% it's not going to break out or touch this level. 0.3% chance it will. So, it's very rare, like October 2008 rare, except for certain markets. I will say when certain things happen, a certain surprise Fed announcement comes out, you may see gold move this far. Now to see that move on things like indices is really, really, really rare. But you can see it move on, certain markets. The thing is, it's built into that price. Okay, it's actually built into the price of the market, and it'll go in and they'll actually widen out. I've seen these deviations get huge, and I've also seen them get very small. Okay, so it's that probability of touching, and then settlement price. Okay, this is taken from you could use yesterday's close and all that stuff, but we're actually using settlement. And if we go to settlement. We use the VWAP method that comes out of the CME. Okay, actually they post it on their website every day. And they take all the trades that happen in the last 30 seconds. They multiply it, so let's say they're doing S&P. They multiply every price times the volume traded at that price. So say the S&P was at 1,400. 1,400 times 7,000. 9.8 million is the weighted value, the volume weighted price. Okay? And they sum up so they take every price, multiply times this volume, that gives the weighted value of that price. Brings it on down, that gets you a sum of the weighted value. They take the total volume in the last 30 seconds. So say that was 26,000 contracts. And then they take that sum of that weighted volume, divided by the total volume, and they get a settlement price rounded to 1 tick. So in this case, 1,400.25 by taking all those. And that's the settlement price. It's used for market, that's used for option exercise, things like that. It's very important you know what settlement is. A lot of traders don't know the difference between settlement and the last close on their chart. Some charts match up, some don't. Some match up most of the time, but not all the time. And so we actually put the exact settlement price in the banner. And that settlement price is actually just like a deviation level. So if it goes down and it starts flying back up, we treat the settlement just like another deviation. Because like from 0.5 to settlement would be half a deviation move. So we tighten our stops on that as well. And looks like we got a caller coming on in. We got Richard from New York calling in about Apple. You there, Richard? Oh, I lost you. All right, well, give me a call back, Richard. Ready to call right there. Just want to wrap up that statistic level there. And let's see here. So if Richard comes back on, they'll let me know. But we can definitely check out Apple. So it's coming up. We got a big earnings play coming up, right? So the earnings right here around the corner. So... and it's one that you're not going to play the same as the Google play because of the time it comes out. We'll talk about that when it comes up later. But anyway, so that's the deviation levels. That's how they work. And, got Richard back on the line. Richard, you there?
Yeah, hi, Darrell. Sorry, I got cut off. You were talking about the Apple earnings and how you anticipate maybe to play it differently or the same?
I'm definitely going to have to play it differently. So because Google earnings comes out like at 4 o'clock in like a second, right?
Right.
But Apple doesn't release, now their conference call may happen 30 minutes later, but their earnings statement, Apple doesn't release their earnings till after the bell, the actual futures bell. So if you go in and straddle it, you're probably going to lose. If you straddle and strangle it. So I'll usually go and I'll try to do a binary butterfly on it. So I'll go in before it, and I'll do the inverse of a strangle.
Okay.
As wide as I can get. It's usually really close. Like when it expires, I mean, if it, like the last couple times it's worked really well, but it'll come in like, I mean, within a couple ticks. And
what is your hunch? You think it's going to be bad news? It's going to be leaning towards the downside? I mean, how do the options seem to indicate that it's going to that it's going to play in terms of the earnings release? A lot of people are talking about it's going to be a bad news report.
It'll probably be a I mean, they've been writing them down like crazy, so that gives them an edge, you know. But the tech sector as a whole has done very poor. Lately, obviously, as we know, like Microsoft down 11% and Google getting slammed and everything. But, you know, this isn't Apple's, like, first bat. I think there's a lot of negativity built into Apple already. So that always helps. It's like, you know, if you expect a movie to be bad and you go in and it's not as bad as you thought it was actually halfway decent. So, I don't really have an opinion. I'm sorry. My opinions get me in trouble. But I do go in and I usually straddle or strangle. So if I can't straddle it or strangle it, then I'll go in and I'll butterfly it. But I would expect if it was to go with all the other techs, it'll probably be, it'll probably drag everything down unless it's just stellar. There's so much. I think they'll do better than what some people expect, but I still think there's so much expectation that Apple becomes great again that they're just going to keep driving it, further and further and further down. So it'll probably get slammed again. But there's really, are you trading Apple or are you trading Nadex on it, or what are you doing on it?
Likewise with Nadex, I'm trying to figure out a strategy because in terms of their earnings, like you said, they seem to come out when they want to, and if you're on options, you seem to get hammered because a lot of things can happen overnight and they don't open back up until
right.
The next. And so the advantage of Nadex is, you've got different avenues because of the time that they close.
Right. You cannot do, now understand, again, they come out after 4:15. So you can't do the 4:15 strangle or straddle.
Right.
Because the announcement will come out after the bell. I'm speaking from, unfortunately, personal experience. If you go in and try to straddle or straggle it, you'll be waiting and it'll just expire.
Right, but
so you're not going to get that massive pop until after they've already expired.
Right, but you can put trades on Nadex for the next day or for the end of the week. However, if you're in the futures or on the options market, then they're closed. So at 4:15, they're done. So
you could do the 5 p.m. weeklies if you wanted to. Your gamma is going to be severely stunted. So because it's. Yeah, so you could do that, but it's going to make the binary just not going to move near as fast. So and they'll be a lot wider. So the strikes are a lot wider. They'll move a lot slower. You do have till 5 o'clock on the weeklies, so you can definitely do that. It's just you won't see the move like you just saw on Google. Right. So even if it was huge, you still wouldn't see it because it would move slower and it'll be wider. So that's why I actually butterfly into 4:15 versus try to strangle past it.
Right. Okay. Also, I was asking the other day, I called about back ratio spreads, and I got cut off the other day. Have you done more thought in terms of how to do a back ratio spread, like on the retail side, for example, in contrast to on the wholesale side? I think the market makers, they're holding options on the long and short side of the same strike. But on the retail side, I don't think Nadex does allow me to do that. Is that correct?
Well, yeah, because you'd be neutral. Yeah. You'd zero out your position.
I don't know if that really answers my question. And if I want to hold long and short positions...
if you're long and short something, you couldn't make or lose anything on it, except for the bid-ask spread.
I want to change the number. Suppose I want to hold 3 long and 5 short, or vice versa, or some different combination thereof.
Then you'd be too short.
Am I allowed to do that on the retail side?
No, because you'd be closing out your own position and be too short.
Okay, but the market maker does. He holds some long and some short on the same strike, but, suppose he holds, 1,500 long and he's got 1,400 short, or vice versa, or some combination thereof. It seems like he has a tremendous advantage over the retail guy because he can change his combination of long and short on the same strike, whereas I can't.
Not really, because if he's 1,500 long and 1,400 short, then he's 100 long.
Right. Right, I understand that, but he has a choice to close them and open them when he wants, or to put himself delta neutral with other different options or futures. But that may be more difficult for me to do that.
Well, that's not really how a market maker works, though. A market maker is trying to make a market, make the bid-ask spread. They're not trying to take positions, because if it goes down and he closes just his shorts and leaves his longs on, then he's exposing himself. So the whole point is to have a delta neutral book when you're a market maker. So you may have a whole bunch of longs and a whole lot of shorts, but at the end of the day, all you care about is what am I net, and it's no different. So there's not really an edge there, because as soon as he starts messing with that number, then he's losing his delta neutrality ability of making a book and getting the spread difference between the bid and the ask.
Well, how do you interpret this?
That'd be a market maker that'd go bankrupt.
Okay, well, how do you interpret the definition of a back ratio spread?
Well, how are you trying to do it?
Well,
I understand you're talking about like calls and puts with back ratio spreads.
Right.
Is that where you're trying to go? Because that's not the same thing as a Nadex binary or spread.
Right, but I'm asking you, what is your interpretation of that strategy? Not the way I do it, but how do you interpret that strategy?
On how you would do it on Nadex. Let's see.
Is it possible?
Trying to figure out. Yeah, there's probably a way to do it. I'm trying to think of the best way to actually pull it off. Obviously, you want to bring in more premium because you're trying to do a sort of a premium collection style strategy on the higher ones and the lower ones on it, right?
Could we agree that we're selling premium to finance directional moves?
Correct, of course, yeah. So, but you're trying to figure out how to sell enough premium to finance that move.
Right.
So putting that together and doing it on this, obviously your vertical, you're doing it on the same expiration. Just trying to figure out the best way to actually pull it off. Have you started playing with it at all yet?
There's a lot of different options, but you're more experienced than I am, and it seems that a lot of times using my own capital to finance directional moves is not very wise. Or is not as lucrative as if selling premium, because the market doesn't move dramatically with the exception of a few days a year. There's only, 5 or 6 days a year that it moves dramatically. So in the duration, why not sell premium to prepare myself for those directional moves?
Right. So you're going in and let's say, I don't know, let's check out Russell. Okay. Just for instance, at the moment.
Right.
And let's pull it up. And we'll go over here, and then let's look at, let's see here, what we got on the Russell, 1049. So we're trying to figure out a good combination. It could be a great strategy. It's just a matter of putting it together to be able to, like I said, finance it. But you got to get enough to finance it. And you have to take on quite a bit of risk to do it. So I guess that's what you're trying to do too, right? You're trying to figure out what's the best way I can actually pull this thing off. Hey, stay right there. We'll look at this in more detail right when you get back. I'll pull up a combination. We'll look at it, okay?
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this prospectus and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, welcome back here to the Diagnostic Trading Hour here on TFNN. We're looking at an example of a ratio spread from Richard. Wanted to check it out here. You still there, Richard?
Yes, absolutely. How would you work this out, Darrell?
Okay, so looking at, I just pulled the scanner out to try to see one that would line up. To be able to, obviously pull in a net credit for a directional play on a ratio spread, you're probably going to have to use like an in the money, like two in the monies, obviously, and then an out of the money. That's about the only way I can see to put it together. And so that way what happens, like if I put in, say, like a buy 1049.5 at 3 o'clock, and I bought it for, $76.50 is the live price at the moment, okay? Then I would bring in $47 on that trade, as long as it stayed above 1049.5, okay?
Right.
And then if I went in and also bought the 1051.5, then it would finance that. Basically, the first one would finance the second one. Because it's like you're selling and buying because one's in the money and one's out of the money. So you're getting that credit on time. So that's how you're selling. On the ratio spread, you're going to be you're going to buy one strike and you're going to sell another. Well, this is sort of like buying a 1040. How do I put this? This is sort of like buying the 1040 or the 1051 and selling the 1049 because you're bringing in the credit on that 1049. So this is one way to do it.
Are they expiring at the same time or expiring at different times?
Oh, the same time. Yeah, otherwise you'd be going into, a diagonal.
Okay.
So, but if I bought two 1049.5s, and then if it expired anywhere above 1049.5, I'd bring in more than enough premium to pay for my 1051.5. Okay? Or I would have when we were first talking. And so, I would have brought in $47 and I had a risk of $26. Okay? And so I brought in basically like $20 no matter what, so long as the thing stayed above 1049.5. If I was right and the market bounced and went long and the Russell stayed above 1051.5, then I could actually increase my profit by as much as $75 on top of that entire trade. So basically what I guess a back ratio would be going in and doing a deep in the money, say binary, doing two of them to finance one out of the money binary, and then if you're right about direction, then you make, quite a bit. You'll end up bringing in, say, $125 on the trade. If you're wrong about direction, then, of course, you're going to lose, the $26, and you're probably going to lose, as long as you'll get out, if you'll finance for, say, $75, if you'll get out, then you lose about $75. So you have the potential to make $75 or lose $75 on the trade. You have the potential to, as long as you'll get out when it hits the strike, like 1049.5, you could lose a lot more if you don't. You have the potential to make $125 if it goes in your direction. And if it just sort of stays flat, then you can make $50.
Well, what is
actually, I guess net $25. You wouldn't even make 50. You'd make like 25 because you'd lose 25. You bring in 50. You'd net out $25.
Okay. What is your opinion of spreading it over time, like doing it, selling at this point the nearest expiration and buying at the end of the day?
Selling at the nearest expiration obviously is going to give you maximum theta decay. So, which is going to help it, profit sooner. Buying at the end of the day is going to cost a lot more money, give you a lot less gamma. So, I mean, it's a type of calendar spread. You need to sell enough to actually be able to finance it. So that'd be a little bit more, difficult because you're going to have to pay quite a bit. You have to get quite a bit more. Like we had to do 2 to 1 on just the same expiration. So if we go in here and we switch it around, and let's just say we look at 415 right now. All right, maybe I can look at the one that's about to come up here. Let's see. I'm just trying to see if we have much at 2 o'clock. Yeah, you're just going to have to sell a lot more. So you're going to have to increase your risk. That's the challenge.
Right. Okay, Darrell, thank you for your help. Thank you.
Hey, you bet. Good call. Thank you. All right. Well, great call there by Richard. Always appreciate you calling in. And we'll explore more. Just call in as soon as you can tomorrow. We'll knock it out even deeper. Thank you. All right, y'all have a great day, and we'll see you back tomorrow.
Nowhere, spelled N-O-W-H-E-R-E. At one point, we've all been there, whether it be our health, career, or our finances. Some might be there right now. So where are you when it comes to your trading and investing? Better yet, where would you like to be? The good news, I can take you from nowhere to now here right now. Same letters, N-O-W-H-E-R-E, just a totally different emphasis and focus. Hi, I'm Steve Rhodes with TFNN, and on July 25th at 6:30 p.m., I'm going to share with you a trading strategy that I began on May 10th when the S&P was at 1627 and closed at the same price 8 weeks later. That's right, the S&P went nowhere versus a trading strategy that produced a 100% hypothetical return in that same period of time, and it's now here for you. Subscribers to my daily newsletter service, Mastering Probability, have free access to this exciting live workshop. The trend is your friend. All the details are on the homepage of TFNN.com. Decisions shape your destiny, and your trading destiny is now here for you.